have a case that I'm working on right now. I won't go into the gory details, but there's an issue that has arisen that I think might be more common than I think, or than the people involved think. And that involves financial reporting and financial statements and tax returns. There is a difference between a financial statement and a tax return, both as to the purpose of the documents or report, and also as to what is included on those. When we talk about financial statements, the most common ones are an income statement and a balance sheet. Those are documents that you can prepare for an individual, for a company, or any type of organization. They reflect as of a particular date in time, like the end of a quarter, the end of a month, the end of the week, or today, what the financial situation is for the company. Now, you have to know a little bit about accounting. First of all, it's going to depend upon whether you're on the cash basis, which is what has actually been received and spent and what is actually there, or accrual. And accrual is when a manufacturer makes a product and makes the sale. They may record that sale on its books before they have actually been paid for it. Likewise with certain of the cost of goods sold portion of it, they may keep track of what they have acquired to build this product, but they may not have actually paid for it. So, but anyway, it will be consistent, either accrual or cash. So that's just a little extra there that you may not even care about. But an income statement starts out, it is what the cash flow of the business is. It's going to show the income and expenses. So this might be on a day, on a week, on a month, on a year, whatever the time frame is. And it's going to show the actual income, based upon whether cash or accrual, but the income, and then what the expenses are against that income. So you have a gross income, then you have your expenses, and then you have your net income. That's what actually has filtered through and is left over. Hopefully it's not left over, it's on purpose, after the expenses are paid. So that's what that shows. Then the balance sheet is different. The balance sheet is on the assets and liabilities. Now you might say, well, wait a minute, expenses are my bills. Well, for a person, yes. So for those are the actual bills that were paid. But on the balance sheet, we're talking about liabilities, current or short-term and long-term. So here you're going to say what your assets are. Yes, it will include cash, but it'll be whatever cash there is, either in a cash account, a DDA account, an investment account, a CD, whatnot. Those total amounts are going to be there. Now the income statement is what was received during this period that we're reporting, but this over here on the balance sheet is what we have on hand. So first you're going to list your assets, and there's real assets, there are personal assets, and there are intangible assets. So it's going to be what's real: cash, property, jewelry, something tangible that you can touch. Then you have and real is real estate. Personal is personal property, jewelry, things that can be sold and liquidated for cash. And then obviously your liquid assets, which are things immediately turned over into cash, which would be cash and investments accounts and things like that. So that's all of the assets of the company or person. And then you have the liabilities. So you have all the assets, now all the liabilities, and that is current liabilities would be if you've got electric bills and tech bills and phone bills and things like that. That's a current obligation. Then long-term would be for a person would be a car loan, a mortgage, a student loan. If you've borrowed against your 401k, that loan. If you borrowed from your parents or something, that loan, and that would all be listed also. And then the difference, the difference is going to be retained earnings for a company, and the retained earnings plus the liabilities equals the assets. So those are the financial statements. Now the tax return, a tax return shows your gross. If it's a person, your earnings, either as an independent contractor or an employee, your total earnings, which is similar to the income statement, but this is for a year. This is for that particular calendar year. All the earnings. Then if you've got child support or things, those are added in. If you have dividends, those are added in. So here we're just talking about cash. Then you have deductions. You have itemized or standard deduction. The deductions are going to relate somewhat to expenses on an income statement, but we're going according to the tax code. So you don't get to include all of them. You don't get to include all of them in the full amount. And you know, for example, if you have mortgage interest on your home, you don't get to deduct the whole mortgage payment. It's just the interest portion. If you have health insurance, that is a percentage of the total amount. If you have out-of-pocket expenses, not health insurance, but health costs, a percentage. And some of those are based on your income. If you're itemizing, you have to have a certain amount of income in order to itemize. So the tax return is a picture of what the income has been, and then less the deductions based upon the tax code. It is not the same as an income statement. They tell different pieces about the person or the company, which is why, for example, a bank is going to ask for, or an investor is going to ask for, a financial statement or a set of financials and a tax return. A tax return also for equipment is going to show depreciation, and that can be deducted. And there are certain deductions that you take on the tax return that are for the purpose of determining what tax you pay, not how much money you have, how much money you've made, how much money you have available, etc. I hope that that helps a little bit, but I didn't realize that this was as common of a question as it was. And as I get further into this issue in what I'm working on, I may be back for more, but I hope that that helps at least with the basics.